Hello, everyone, and welcome to a market update. Today is Friday, the 12th of June. I trust you had a nice short week off the back of what I hope was also a fantastic long weekend. The weather's just been amazing over these last couple weeks, not very cold at all in the mornings or during the day, so that's very nice. Top three things today are going to be, and there's a lot going on. I know I always say that, but this is going to be an important market update because of some of the things I need to just share with you. The first thing is inflation. Number two is going to be growth, and number three is going to be quads shifting. The first thing is inflation. So the Hedgeye Nowcast, if I can just get to the inflation chart, here we go. The Hedgeye Nowcast, so actually, let me start that over. On Wednesday, U.S. time, we had the CPI figure for May come in, and that came in at 4.24%. That was the headline number. As you can see on the screen, the Hedgeye number was 4.25. So they were so close to that number. They were pretty much right on the money in terms of what the number was. And that's important because they have shown themselves to be exceptionally good at um, modeling and getting the right information and inputs into their inflation nowcast. That's really important because inflation is a key driver of what goes on with policy. So that's your interest rate regime. And of course, it's nice to see, what the inflation number is doing or where it could be going, because as consumers, we're all affected by inflation. It does impact how much it costs to put fuel in our car, to how much a basket of groceries costs. So I suppose the good news here is that inflation looks like it's peaked and is beginning to decelerate. For how long, we'll see, but right now we're in an inflation decelerating trajectory. So that's a good thing. We do definitely want to see inflation coming down because ultimately that's going to, I think, lead to the Fed and then now this is the U.S. number, but eventually in Australia, the RBA being able to cut interest rates. And I think the RBA will probably be cutting interest rates by the end of the year, and I'll talk about that a little bit more in a moment. But the second part of this story is growth and what is happening with growth. And I just want to get a different chart up here. So this is the US GDP trajectory prediction, or projection, I should say, for the next 3 quarters. The first quarter of 26 was a positive GDP number, and then we've just had numbers now beginning to slow. So GDP slowing slightly here in the second quarter, then in the third quarter slowing a little bit more, re-accelerating in the fourth, and then decelerating again in the first quarter. So growth is going to be a little bit up and down in the U.S. Probably this third quarter growth number, we're going to get to it, and we're going to see that the Fed might be able to cut interest rates in the U.S. and may have cover to do that, because if inflation continues to decelerate and growth is decelerating, that puts us in a very specific quad, which I'm going to talk about here in just one moment. But growth decelerating and inflation decelerating is not a good combination, and here is why. When growth and inflation are decelerating, that is a quad 4 environment. That is bad for asset prices. It's good for some other asset classes, but it's broadly bad for everything. Tech, small caps, commodities are probably the three biggies. Gold doesn't like that environment either. So it generally doesn't like that environment. So that is a really bad environment for a lot of asset classes. The asset classes it's good for are pretty much holding cash and some short-term fixed income type securities because of the low volatility of those types of assets. So where are we going and why am I spending time on all this? Well, the quad map for us is right here in July. I was talking about this earlier this year. You may recall when we were in sort of Jan and Feb, we were looking at this monthly quad map. And around that middle part of the year, you can go rewind the tapes. I was showing you a table just like this, and I was saying around that July, August period, we've got a little bit of a rough patch potentially coming up. Well, the market knows that and has already, things have already begun to slow down. And you can see that in charts of a number of things and a number of the holdings that and positions that we've had on. They have had a top, and the top of the market was probably about 1 to 2 weeks ago when we saw all-time highs in the Nasdaq, S&P 500, some of the other indices. Those things have now come off, and I think the market is discounting that we're going to have a quad 4 in July, and it will typically, the market seems like the machine will typically begin that discounting process sometime in the middle to back half of the previous month. So we're in June, which is the previous month to July. The market is starting to do that. The machine is starting to do that. And so it's anticipating that we're going to have that quad 4 environment in July. What does this mean? Well, it means that we should be really adopting a defensive posture and raising cash, because quad 4 environments give us buying opportunities in lots of things. If you rewind the tapes and you go back and look at your portfolio and what it was doing, say in November and December of last year, we had a sell-off in that period of time, and there was some great buying opportunities back then. And so what I'm hoping we will find is that as we get into the later stages of June and then early July, that we'll start to see market sell-off perhaps accelerate, and we'll get an opportunity to buy back some of the positions that I have taken profits in. So one thing that you should never ever be ashamed of or worried about is taking profits in something. Locking in capital gains, always a good thing. Sure, you're going to pay some tax on that, but I would much rather pay a little bit of tax and lock in gains and then rebuy those things maybe a month or 2 months later, depending upon the environment, for 15, 20%, 25% off, than ride that whole wave and have the emotional, damage of watching the account value go from, say, an all-time high to something much less. So you're a professional when you can do that sort of thing. And so I'd invite you to, obviously come along the journey on this with me in managing the money that way. That's really important as a lesson to understand. Is it, again, never anything wrong with taking profits. The market's always going to serve up an opportunity for you to buy things back, especially with all the tools and things we have available to us now. We're getting very good at that sort of thing. So to recap that, what's going on in the markets, or to sort of really put a nice exclamation point at the end of this sentence. Well, let's talk about volatility for a second, because I do talk about that a lot. The volatility of the Nasdaq has really popped all of a sudden into the F bucket regime. So this is the no-go zone where we really can't be invested or shouldn't be invested in Nasdaq sort of security. So that's your tech exposure. Why? Because volatility is quite high. Volatility would need to just really ramp down quickly back into probably that low 20s level. And we would have to see some other things change in the market structure in order to even think about going back in size, back into tech. For now, I am keeping a little bit of tech exposure on, but again, I've raised a lot of cash, which is going to enable us to buy some things back if and when we see a market correction. The U.S. S&P 500, similar thing. It's had a run back up into the sort of low to mid 20s. It's in the chop bucket, and unfortunately, what we're observing is that volatility looks like it could go much higher, and interest rates look like they can go lower. So what is this all about? So the market is discounting that we may have some rate cuts coming. It's discounting that because it sees and knows that growth is slowing. That is driving a few other metrics in the background, like volatility, and it's going to suck the wind out of the sails of momentum and trend following stuff that has been occurring over the last few weeks. It's going to suck the wind out of the sails of tech and some of these high flying, high beta stocks. It's going to suck the wind out of small caps and things that perform really well in a quad 1 or quad 2 environment. And just generally, it's going to potentially cause some problems in markets. Is that definitely going to happen? I don't know. But right now, the signs are, and the probability is that it is going to happen. Are we going to get a 20% correction? Don't know. Is it going to be 10, 15? Again, don't know. but it is shaping up that we will get some sort of correction in the month of July. So that's going to be really interesting to see what plays out. But we are ready for it. Again, with cash now being raised in accounts, locking in profits, giving us the opportunity to rebuy things when they go on sale. And that's what July looks like. Even August is going to be a tricky one because of this quad 3 environment. That could quite easily drift into a quad 4. It could also drift up into a quad 1 or 2. You just have to wait and see what the data is looking like as we get a bit further down. Now, I did say I was going to talk about Australia, so let me just make this image a little bit bigger because Australia has some other issues coming up that are going to be quite interesting. So Australia, this is the GDP. I know it's a little bit tough to read, but just focusing on that red number right there. We've had GDP in Australia slow down from the first quarter. It looks like it's going to accelerate a little bit in the third quarter, but then in the back half of this year and in the beginning of 27, we have some really bad GDP numbers coming out. We will continue to have accelerating inflation probably for the next 1 or 2 quarters, and then it begins to slow. So what I'm thinking is going to be happening in Australia anyway is that the market here is going to start discounting that we're going to be in a real slow growth environment by the back half of this year. We're just going to have to keep an eye on the Australian market and see. I'm really less worried about the Australian market from an investing point of view because I don't have a lot of Australian equities in client portfolios because Australia only represents a very, very small portion of the global markets. I think it's about 2%, probably a little bit less. And the opportunity set here isn't as big as it is in the US. Having said that, I do own Australian listed exchange traded funds that invest in things like the Nasdaq and the Russell and some of the other US exposures. So the composition of those ETFs, they are listed in Australia, but they are predominantly offshore or overseas or US listed securities. So I thought it was just interesting to look at this quad map for Australia and just see that we as an economy here, we're going to probably continue to slow into the back half of this year. I talked volatility, talked about Australia, talked about interest rates. Again, we're discounting this quad 4 setup for the next month, so in July. And usually what happens with a quad shift is you'll see that begin to be discounted actually sometime around right now. And again, that's pretty evident on some charts. For example, if I go to say a chart of, let me just grab a chart of the Russell 2000. This is the Russell in the U.S. It is starting to slow. So it's come off a little bit, and now it had a nice pop in the last day, which is good. That's the selling opportunity, which is exactly what I'm doing with that. But the Russell volatility has spiked a little bit, as has the other two, which I've already discussed. But things like small caps, which is what the Russell is, they don't like quad 4 at all because when growth is slowing and inflation is slowing, that's really just not good at all for small caps. That's probably all I really need to relay at this point. If you do have any questions about any of this, feel free to pick the phone up, put yourself in the calendar to have a quick chat about it. But for now, just keep an eye on what the market is doing because that's what I'm doing. I'm going to do what the market is doing. And the market right now is slowing down. Interest rates are falling. That's because the market knows that that growth is falling, which means, again, likely interest rate cuts and things like that are going to be coming down the pipe. So with that, I'm going to say have a fantastic weekend. Thank you for watching. And again, if you do have any questions about anything, please sing out. Oh, one final thing. For anyone that obviously you would know the end of financial year is coming up, be sure to make those last minute super contributions if you need to try to confirm what your available balance caps are. Please let us know. We have sent out emails on that to a number of you. And of course, minimum pension payments and things of that nature need to also be made if you are happen to be in a pension. So with that, I will say once again, have a great weekend and talk soon. Bye bye.